Imagine you woke up tomorrow and every bank in the world was gone. Every ATM, every vault, every dollar bill vanished. Most people think that would be the end of money. But here's what nobody tells you. The real financial system wouldn't even notice. Because the money you see, the cash in your wallet, the balance in your account, the GDP of entire nations, that's not where the actual wealth lives. That's just the surface. Underneath it, hidden in plain sight, there exists a financial universe so enormous, so complex, and so deliberately obscured that even most economists refuse to look directly at it. We're talking about a system worth over $500 trillion. That's not a typo. 500 trillion. And the most terrifying part? You have never once been taught it exists. This video is going to change the way you see money forever. Not in a motivational way, not in a here's how to save better way. In a way that makes you realize the entire game you thought you were playing has different rules, different players, a completely different scoreboard. And by the time this video ends, you're going to understand something that 99% of people on this planet will never understand. Why the real economy is invisible, who controls it, and what it means for every financial decision you will ever make. We're going to start with something that seems boring. Derivatives. That word probably makes you want to click away. Don't. Because derivatives are the skeleton key to understanding everything. We're also going to talk about shadow banking, a system that holds more money than all the world's traditional banks combined and operates almost entirely outside the rules you think govern finance. And then, at the end, we're going to answer the question that ties all of this together. If this ghost economy is so powerful, why has nobody stopped it? The answer is darker than you think. But first, let's establish something important. Something that reframes everything. You have been taught that the global economy is measured in GDP, gross domestic product, the total value of all goods and services produced in a year. The United States GDP is around $27 trillion. China is around $18 trillion. The entire world's GDP combined, every country, every factory, every service, every transaction, is roughly $105 trillion per year. That number feels enormous. It should. It represents the labor of 8 billion human beings. Now consider this. The derivatives market alone is estimated at somewhere between $500 trillion and $1.5 quadrillion, depending on how you measure it. That number is between 5 and 15 times the value of everything humanity produces in a single year. This is not theoretical money sitting in a vault somewhere. It is active, it is moving, it is making decisions, and it is almost entirely disconnected from the physical world you live in. To understand how this happened, we have to go back. Not all the way to ancient banking, just to 1970s America, because that's when the first domino fell. Before the 1970s, the financial world was relatively constrained. Banks took deposits and made loans. Governments issued bonds. Companies issued stocks. It was all interconnected, regulated, and relatively transparent. Then two things happened almost simultaneously that changed everything. First, the United States abandoned the gold standard in 1971. Richard Nixon announced that the dollar would no longer be directly convertible to gold. This sounds like a policy detail. It was actually a revolution. For the first time in modern history, money became completely abstract. It wasn't backed by a physical commodity anymore. It was backed by confidence, by belief, by the collective agreement that a piece of paper had value because everyone agreed it did. Money became, for the first time, purely psychological. Second, financial deregulation began in earnest. Throughout the 70s and 80s, one rule after another was loosened, removed, or simply ignored. Banks were allowed to do things they couldn't do before. New financial instruments were created, and slowly, a parallel financial universe began to take shape. The architects of this new system were brilliant, genuinely brilliant. They were mathematicians, physicists and economists who had left academia and gone to Wall Street. They looked at finance the way an engineer looks at a bridge, as a problem of structure, load, and risk distribution. And they invented something that, in theory, was elegant. A way to transfer risk from people who didn't want it to people who did. They called these instruments derivatives. Here is the simplest possible explanation of a derivative, because this concept is everything. A derivative is a financial contract whose value is derived from something else. That something else is called the underlying asset. It could be a stock, a bond, a commodity like oil or wheat, a currency, an interest rate, even the weather. A derivative doesn't give you ownership of the underlying asset. It gives you a contract tied to the price or behavior of that asset. Imagine a farmer who grows corn. He doesn't know what the price of corn will be when harvest comes. Maybe it'll be high. Maybe it'll crash. That uncertainty is risk. A food company needs corn to make products. They also face uncertainty about price, so they make a deal. Right now, today, they agree on a price for corn to be delivered in 6 months. The farmer locks in revenue. The company locks in costs. Both reduce their uncertainty. This contract, this agreement about a future price, is a derivative. Specifically, it's a futures contract. And in this form, derivatives make complete sense. They're useful. They reduce real economic risk. That's where the story should have ended. It didn't, because once you have a contract that can be traded, you don't have to be the farmer or the food company to own it. Anyone can buy and sell that contract. Speculators, hedge funds, banks, pension funds. And here's where the abstraction starts to spiral. You can make derivatives of derivatives. You can create contracts whose value is derived from other contracts, whose value is derived from other contracts, whose value is derived from an original asset that is, by now, so far removed from the chain of abstraction that nobody at the end of the chain actually knows what they own. This is not hypothetical. This is exactly what happened with mortgage-backed securities and collateralized debt obligations before 2008. Millions of ordinary Americans took out home loans. Those loans were bundled together and sold as bonds. Those bonds were then sliced, repackaged, and sold again as new instruments. Those instruments were then used as the underlying asset for credit default swaps, which are essentially insurance contracts on whether those instruments would fail. And then those swaps were bundled and sold again. By the end, you had Wall Street traders buying and selling contracts that were 4 or 5 layers removed from the actual mortgage of a schoolteacher in Ohio who was struggling to make payments. The schoolteacher's financial reality and the Wall Street trader's financial reality were technically connected, but they might as well have been on different planets. When the schoolteacher defaulted, the entire chain collapsed. And the shock that was supposed to be contained within one small sector of the housing market became a global financial crisis that wiped out trillions in real wealth, destroyed millions of jobs, and caused suffering that is still being felt today. That was the warning. The world watched the system nearly destroy itself. And then the world did something extraordinary. It rebuilt the exact same system. Slightly modified, slightly more regulated, but fundamentally, structurally identical. This is where everything changes. If you've been watching this and thinking, okay, this is about Wall Street, this doesn't affect me, you need to stop thinking that. Because here is the mechanism by which this invisible economy reaches into your life every single day, whether you know it or not. Interest rates. Every time a central bank like the Federal Reserve moves interest rates, they're not just adjusting the cost of borrowing for banks. They're sending shockwaves through hundreds of trillions of dollars in interest rate derivatives. Contracts whose entire value depends on the direction of rates. When the Fed raised rates aggressively in 2022 and 2023, the impact on ordinary mortgage holders was obvious. What was not obvious was the simultaneous implosion happening in the derivatives market. Pension funds in the United Kingdom nearly collapsed in 2022 because of interest rate derivative positions that went wrong. Pension funds, the retirement savings of millions of ordinary workers. nearly wiped out by financial instruments that those workers had never heard of, managing risks that were supposed to protect them. This is the central irony of the ghost economy. It was built, in part, to manage risk, to distribute it, to make the financial system more stable. Instead, it created risk at a scale that had never existed before. Risk so large, so interconnected, and so opaque that when it starts to move, nobody can stop it. And the people who bear the consequences are almost never the people who took the positions. Now let's talk about shadow banking, because derivatives are just one dimension of this hidden system. Shadow banking is the other. The term sounds sinister. It's meant to. Shadow banking refers to financial intermediation, the process of connecting savers with borrowers that happens outside the traditional regulated banking system. It includes money market funds, hedge funds, private equity firms, insurance companies acting as lenders, mortgage companies, payday lenders, and a vast network of special purpose vehicles and conduits that were specifically created to move assets off bank balance sheets and into a regulatory gray zone. Here's why this matters. When you deposit money in a bank, that bank is subject to capital requirements. It has to keep a certain percentage of your money in reserve. It can't lend out everything. These rules exist because the world learned, the hard way, that banks, without constraints, are dangerous. Shadow banking operates without most of these constraints. A hedge fund can take a position 50 times the size of its actual capital. A money market fund can lend to instruments with essentially no government backstop. A special purpose vehicle can hold billions in assets that never appear on any regulated balance sheet. The Financial Stability Board, the international body that monitors global financial risks, estimates the shadow banking sector at roughly $63 trillion as of recent reports. Other methodologies put the number significantly higher, especially when you include all derivative exposures. Some estimates, using the most expansive definition, suggest the total shadow financial system represents over 3 times global GDP. We are talking about a pool of capital so large that if it moved in one direction, it could overwhelm the fiscal capacity of every government on Earth combined. And here's what makes this genuinely unsettling. We don't fully know what's in it, not because nobody is trying to look, because the system was designed to be opaque. When banks created special purpose vehicles before 2008, the entire point was to move risk off their books so that regulators couldn't see it. When hedge funds take derivative positions, those positions are often reported only to their prime brokers, not to any public regulator. When insurance companies act as lenders, they do so under frameworks that were designed for a completely different kind of risk. The information asymmetry in this system is not accidental. It is structural. It is a feature, not a bug. This brings us to the question that has been building since the beginning of this video. If this system is so dangerous, so opaque, and so disconnected from real economic value, why does it exist? Why has no government shut it down? The answer requires you to understand something about how power actually works in the modern world. Not the way civics class taught you it works. The way it actually works. Every major government in the developed world has made a quiet, deliberate calculation. The calculation goes like this. The large financial institutions at the center of this system are so interconnected with the real economy, so deeply embedded in the credit markets that fund businesses, the bond markets that fund governments, the derivatives markets that manage corporate risk, that allowing them to fail would cause a cascade of economic destruction that would be politically unsurvivable. This is what too big to fail actually means. Not that these institutions are valuable, but that their failure would cause so much pain to ordinary people that no elected government could survive the aftermath. So governments have, in effect, given these institutions an implicit guarantee. They will not be allowed to collapse. If they take on too much risk and that risk goes bad, the government, meaning taxpayers, will absorb the loss. Meanwhile, if the risk goes well, the profits stay private. This asymmetry Private. Gains, socialized losses, is the fundamental operating principle of the modern financial system. And it creates exactly the incentive structure you would expect. More risk, more complexity, more leverage, more abstraction, because if you win, you win. And if you lose, someone else pays. The 2008 financial crisis did not change this. It confirmed it. Banks that had taken catastrophic risks were bailed out with public money. Their executives received bonuses while unemployment hit 10%. The regulatory response, Dodd-Frank in the United States, Basel III internationally, added rules and oversight, but the fundamental structure remained intact. And within a decade, the derivatives market had grown back to pre-crisis levels. The shadow banking sector had expanded. The leverage had returned. The complexity had deepened. Because the people designing the regulatory response were, in many cases, the same people who had built the original system, or had worked alongside those people, or would go work for those people after their time in government ended. This is not conspiracy. This is called the revolving door. It is documented, public, and widely discussed. And it is one of the most powerful forces shaping financial regulation in the world today. Now here is where this becomes personal, because everything we've discussed so far might still feel distant, abstract, something happening in glass towers in Manhattan and London. So let's bring it down to the level of an individual human being trying to build wealth in this environment. You are trying to save for retirement. You put money into a mutual fund or a pension plan. That fund invests in stocks and bonds. Those stocks and bonds are traded in markets that are increasingly dominated by algorithmic trading systems, systems that make millions of decisions per second based on derivative price signals. The price of the asset you own is no longer determined primarily by the underlying business or government issuing it. It's determined by the complex interplay of derivative markets, leveraged positions, and algorithmic responses to those positions. This means the value of your retirement savings can move violently for reasons that have nothing to do with the real world. You are trying to buy a house. The interest rate on your mortgage is set partly by your bank, but that bank's cost of capital is influenced by the bond market, which is influenced by the derivatives market, which is influenced by the positions of hedge funds and institutional investors responding to central bank signals. A derivatives trader in London taking a position on interest rate futures can, through this chain of connections, influence the monthly payment you make on your home. You run a small business. You need credit to expand. The availability and cost of that credit depends on whether banks are currently holding excess capital or deploying it into higher return derivative strategies. When banks find more attractive returns in financial engineering than in lending to small businesses, credit tightens. Your growth stalls. Not because your business is bad, because capital found a better return in abstraction. This is the ghost economy reaching into your life. Not dramatically, with a single event you can point to. Gradually, continuously, through every interest rate, every credit decision, every asset price. It shapes your financial reality without ever announcing itself. So what do you do with this? Knowledge. This is the part that most people who explain systems like this skip. They explain the problem, and then leave you feeling helpless. That's not what this channel does. Because understanding the architecture of power is the first step to navigating it effectively, not fighting it. That's largely futile for an individual. Navigating it. The first principle is this. In a system dominated by financial abstraction, real assets hold a different kind of value. Physical real estate, productive land, commodities, businesses that generate actual cash flows from actual economic activity. These are anchored, however loosely, to the real world. They are not immune to the ghost economy. Nothing is. But they have a flaw that pure financial instruments sometimes don't. When derivatives collapse, the house is still standing, the land still produces, the business still operates. The second principle, understand leverage and be deeply suspicious of it in your own financial life, even as you understand that the system around you is built on it. The ghost economy runs on borrowed money amplified by derivative positions. When the amplification goes wrong, it goes wrong catastrophically. For an individual, the same dynamic applies. Moderate productive leverage, a mortgage on a cash-flowing property, a business loan with clear repayment capacity, can build wealth. Excessive leverage, especially on volatile assets, can destroy it with the speed of a derivative unwind. The third principle, liquidity is not just convenience, it is a form of power. In a financial system where crises can emerge from the shadow economy with little warning, having liquid assets, cash, short-term securities, accessible accounts, gives you the ability to survive volatility and, more importantly, to act when others cannot. Some of the greatest wealth transfers in history have happened not because someone was brilliant, but because they had cash available when everyone else was forced to sell. The fourth principle, and perhaps the most important, the ghost economy, rewards complexity and punishes simplicity for institutional players. But for individuals, the opposite is often true. Simple, diversified, low-cost investment strategies consistently outperform complex financial products designed and sold by the same institutions that operate in the shadow economy. This is not an accident. Complex financial products are designed to extract fees and transfer risk to you. Simplicity is often the individual's best defense. There is one more thing we haven't discussed. One final layer that ties everything together in a way that should leave you thinking for days. The ghost economy doesn't just influence markets, it influences governments. Specifically, it influences the ability of governments to function. Here's the mechanism. Governments fund themselves by issuing bonds. Investors buy those bonds. The interest rate governments pay on those bonds is set by the bond market. And the bond market, particularly for large sovereign issuers, is deeply intertwined with the derivatives market. Interest rate swaps, credit default swaps on government debt, currency derivatives, all of these create a web of financial actors whose positions are affected by government fiscal decisions. In 1994, Bill Clinton's political advisor, James Carville, reportedly said, in frustration, that he used to want to come back as the president or the pope, but now he'd want to come back as the bond market because it can intimidate everybody. That statement was made in 1994. The bond market is 5 to 10 times larger now. The derivatives layered on top of it are a multiple of that. When a government runs large deficits, the bond market reacts by demanding higher interest rates. Higher rates mean higher borrowing costs. Higher borrowing costs constrain what the government can spend. They constrain infrastructure investment, social programs, the capacity to respond to crises. The financial system, through the mechanism of the bond market and its derivative ecosystem, effectively sets limits on what democratic governments can do. This is not theoretical. Italy, Greece, and multiple emerging market countries have experienced this directly. Moments where the bond market's reaction to fiscal policy forced governments to reverse decisions made through democratic processes. This is the deepest truth of the ghost economy. It is not just a financial system, it is a governance system. A largely invisible, unelected, profit-driven governance system that operates in parallel with the formal democratic structures we were taught are sovereign. It does not replace governments. It constrains them. And in constraining them, it shapes the world. $500 trillion. That's the size of the shadow. Everything you were taught about how money works, about how economies function, about what governments can and cannot do. It was all taught to you while ignoring the most powerful force in the room. The ghost economy was always there, running in the background, setting the parameters of what was possible. You've been managing your finances inside a system you never fully understood. Most people never will. They'll work hard, save carefully, follow the rules they were taught, and wonder why wealth feels so difficult to build and so easy to lose. They won't see the invisible hand that moves interest rates, that dries up credit, that inflates and deflates asset prices according to rhythms they can't perceive, but you've seen it now. You can't unsee it. And that changes everything. Not because you can control the system, but because you can stop being controlled by what you didn't know. The money you see is not where the power is. The power is in the contracts, in the leverage, in the abstraction stacked on abstraction until the original asset is just a ghost of an idea. And the real world is just one more variable in an equation that nobody fully understands. The question is no longer where the money is. You know where it is. The question is what you do now that you know. If this video shifted how you see the financial world, subscribe to FinTrove. Because this is what we do here. We take the systems that shape your life and we make them visible every single week. The next video goes even deeper. You don't want to miss it.